If we look at the theme number one, fiscal and monetary accommodation, it is full steam ahead. We had good evidence that investors en masse capitulated pretty much at the low in early April of last year.
Because we've seen now multiple months, years of a higher trend starting to form. Because once you see that relative change here, like you're showing on the screen, that's when we know it's time to move.
Welcome to the Tactical Edge, a show that sorts through all of the noise and commotion out there in an unrelenting pursuit of the signal. Thanks for joining us.
Raj Bhuyan is a managing partner of Tactical Wealth Management. Advisory services are offered through New Edge Advisors, LLC, a registered investment advisor. Opinions expressed and information shared are for informational and educational purposes only and should not be considered as a solicitation for the purchase or sale of any security. Please consult a tax or legal professional for any specific information related to those topics. Past performance may not be indicative of future returns. Investing involves risk and the possible loss of principal capital. For those seeking additional information, please visit our website at tacticalwm.com and contact us.
Welcome back to the TWM Tactical Edge podcast. I'm Raj Bhuyan, a managing partner at Tactical Wealth Management, and very excited to bring this episode number 5 your way, as we will have a special guest joining us later in this program. And the timing is pretty good as we are rolling over into a new calendar year, and this gives us an opportunity to talk about what happened over the past 12 months in 2025. And also lets us address and readdress this idea of perhaps a major rotation that could be taking place. So we're titling this New Year, New Trend with a question mark. And a fitting quote would come from Doug Casey, the well-established financial author, who recently said in an interview, "The inevitable is now approaching the imminent." And if one were to peruse the chart patterns of a lot of asset classes over the last 3 or 4 months, especially, yes, things kind of do look a little imminent, especially as it relates to this concept of a change that could be taking place. So let's look into 2025, the year in review. A year ago, we posed this notion in our year-end 2024 newsletter and basically put out this idea and this thesis that the government, the US government, probably had a major decision to make, perhaps in the first half of 25, in regards to the direction of fiscal policy, especially. We had a lot of fiscal dominance in play, but there were also trends were taking place where the markets were taking that dominance into account. And so the question is, would the government start pursuing something more austere where the balance sheet of the federal government would be addressed as, we're looking at $2 trillion or so being piled up on an annual basis. Initially, we saw the government with the new administration coming in pursue that path. That's the path to the left of fiscal austerity, ripping the Band-Aid off, etc. We saw Scott Bessent, the Treasury Secretary, in the middle of January of 25, say, listen, the United States does not have a revenue problem, it has a spending problem. This is where we saw the push towards DOGE, the Department of Government Efficiency, this idea of taking the deficits from 6 or 7% of GDP and cut it in half. Of course, that would require the government to step away from all of the infusion coming into the economy. And if you add upon that all of the tariff talk, which was very difficult for a lot of business owners to really discount in real time, we saw a pretty sharp decline in the financial markets, in the equity markets especially, with the Mag 7 stocks losing 25%, and the overall S&P losing closer to 20%. Now, after a nice reflective bounce in the early part of April, we saw a complete pivot by the administration, where now Bessent in middle of May was saying, listen, we have a problem with debt. The debt might grow, but what's most important is to grow the economy faster, have the GDP grow more quickly. That completely changed the tune. You might remember Doge was kind of kicked out for the most part. This idea of taking 2 million people off the federal payrolls was completely, for the most part, abandoned. And then we had a really strong rally in the markets, where in middle of May, the Mag 7 stocks were down about 4.5%, and they really made a really large move. And by the end of October, they were up 25% for the year. So if we look at the theme number one, fiscal and monetary accommodation, it is full steam ahead. The monetary tightening that started way back in 2021 and into 22 was really reversed for the most part. Now, the chart on the left we use in our most recent newsletter, and it really documents just how much fiscal and monetary accommodation has been infused in the global economy for the last 30 some odd years. We're looking cumulatively of $126 trillion. That supersedes the entire value of the global stock market today. This is an unbelievable amount of money. And this goes back to, ever since we've been off the gold standard, there's been really no regulator in terms of how much money can be created. Now, if we look at the direction of the central banks from 3 years ago, at the end of 2022, we had 90% of the central banks around the world hiking rates. Today, we have essentially the opposite. 84% of central banks are easing rates. So we have a much more accommodative environment than we had 3 years ago. And the reason for the accommodation could perhaps be put on the backs of all of the treasury issuance that will probably have to come down the road over the next couple of years. We have something like $14+ trillion coming due. If you include the deficits over the next year projected, we're looking at upwards of $18 trillion that'll have to be funded over the next 24 months just in the United States alone. That type of prospect has put some weight on the trade-weighted value of the US dollar. We had a peak back here in December of 22, and if you see here, even after a nice rally in 24, we have the dollar breaking down, breaking below this declining wedge pattern. We had the dollar kind of rally into the fall and then fail that rally with an ultimately a nearly 10% decline. That type of decline has been a large one, most in over a decade, and it really changes the math with regard to how international investors are getting treated or how US investors are being treated with international investments. What I mean by that is, if you're a US investor and perhaps let's say you had some money invested in the Brazilian Bovespa or the German DAX, your return on capital trade weighted for the US dollar's decline was very good. 51% in Brazil, nearly 38% in Germany. However, those Brazilian and German investors, and they invested in the S&P 500 where the price index was up over 16%, they did not do so well if you include the currency adjustments. They made only 3% and 1%. And if you think about all of the money international investors have invested in the US today, which is at generational highs, the highest since 1968 as a percentage of total investments invested on United States shores, that could be a problem if we don't see some type of reversion to the mean from that standpoint, because ultimately those dollars could go elsewhere. Now, going back to the Fed easing, some people believe the Fed was lowering rates to actually really help the housing market. Well, to date, we haven't seen any response with the long end of the yield curve. In fact, since the Fed started lowering rates in September of 2024, we have 30-year mortgages actually a little bit higher. And that is going to, of course, continue to put pressure on the housing market. We have gone from a very tight housing market in late 2021 to now conceivably a very oversupplied housing market if you look at the number of houses for sale and the number of active buyers. And what's very interesting is that even with this huge oversupply, we're not seeing prices really drop that much. In fact, we're still seeing this trend of higher lows. This is turning the housing market into a pretty stale environment where you have this lockdown pattern. Sellers that don't want to sell below a certain price, and of course, buyers that simply can't afford those prices at the current mortgage rates. So this stalemate, we'll see how this ultimately gets resolved, but we don't see any resolution at this point. So along the theme of this easing policy, we believe this is still a major contributor to this really strong valuation pattern we've seen. We're looking at nearly 100 percentile of these metrics. And if we hone in on the 17-ish year annualized return, we're looking at nearly 14.8% price return for the S&P since 2009. That's 99.5 percentile over the last 100 years. Well, what does that really mean for the period forward if you look at history as a guide? Well, let's look at it this way. So we have data points going back to 1928. If we take rolling 17-year periods, we have nearly 18,000 rolling periods, using daily returns. And over those, if we look at the 250 lowest 17-year returns over the last 100 years and the 250 highest, we get a very different idea of what prospective returns could be based on those two cohorts. So if we focus in on the 250 lowest returns, here we're looking at essentially returns over a 17-year period analyzed between -2 and -4.5%. Well, for those periods, the average 10-year prospective return of the S&P was almost 12% per year. Basically, buy low, and then you get a really nice return on the other side. However, if you look at the other side of the equation, these are the top 250 rolling 17-year periods. The next 10 years don't look so good. We're looking at almost -3% annualized for the prospective 10-year period for those returners that had done so well the previous 17 years. And where do we stand today? Of course, you all know this. We're right in the middle of this right cohort at 14.8%, right smack dab in the middle of that piece. And so it doesn't necessarily mean we're going to be surely getting a -3% for the next 10 years, but it does show some chinks in the armor. As we've already said before, the S&P 500, the NASDAQ, those two indices are extremely overweight in a very small subset of the marketplace. For instance, the top 12 stocks in the NASDAQ 100 account for nearly 75% of its market capitalization. Whenever we see that type of concentration, we kind of have some added risks that people may not be completely apprised about from that standpoint. And here's the reason why also we may not see that -3% return. If the dollar continues to fall like it has been in recent years, that could propel markets even higher, not because of actual real wealth accumulation, for instance. It could just be more of a response to some type of low-grade hyperinflation or very high inflation period. This is what we talked about with this idea of the right tail. And that is, if you look at other markets over the years, going back a century, whenever you saw very high returns that are sustained, every single time it was because it was more about currency devaluation than actual wealth creation. Now let's look at the market performance in 2025, and let's break it into three categories. If we look at the more income-oriented categories like corporate bonds, real estate, long-term treasuries, short-term treasuries, and municipal bonds, we had generally up years in 2025, with corporate bonds outperforming, and of course, long-term treasuries doing just barely better than short-term T-bills. Of course, as you all know, we believe the inflation rate was much higher than these types of returns. So yet again, we believe we had a negative year, inflation adjusted, for these asset classes. If we look at the big equity indices, from the emerging markets to developed international to the Magnificent Seven stocks to large cap stocks and small cap stocks. You'll see that for the first time in a long time, international stocks fared very well versus US counterparts. And of course, if we look at the real asset category, this is where we had a really spectacular move in the second half of the year, with precious metals doing exceedingly well, gold finishing up 64% in the year, silver being up 144%, and the mining companies that extract those elements out of the ground up over 150%. With regard to investor sentiment, of course, we are pretty strong contrarians. We've seen the data in how the retail investor typically does not do very well when it comes to timing the markets. In fact, they are exceedingly poor using historical analogs. We had good evidence that investors en masse capitulated pretty much at the low in early April of last year. We had very high volatility readings, and we also had the fear greed index hit multi-year highs just as the market was making low. And using the FANG Plus index, which is essentially the big tech giants, we see this index revert back to its rising 88-week moving average just as people were running for the hills. From a probabilistic standpoint, this would be a good time to consider being more opportunistically inclined. You're at a moving average, the moving average is rising, so you're still basically in quad A, and you have people thinking the world's going to end with all the tariff talk and the talk of Doge, etc. This is a perfect example of when you might want to be adding exposure, because if the markets continue to roll over, you wouldn't have to be wrong for long to change your mind and say, well, maybe this doesn't work out. Conversely, even as we had kind of a mini capitulation event in early December, we still had the markets well off their moving averages. The risk return wasn't nearly as good as it was in April. Now, where did this money go when people capitulated? Well, a lot of it actually continued to go into the bond markets. We are still quite astounded in terms of how much money is going into long duration bonds. We believe a lot of folks are still playing the 2008, 2009, or the 2000 to 2002 recession plays, as for a good amount of time over the last couple of years, we had very high probabilities for recession unfolding. This is something that we weren't necessarily in that camp, simply because there was so much fiscal spending going on with regard to deficit spending. Needless to say, we have nearly $400 billion going into bond funds over the last 6 years, even though we're looking at a minus 5% annualized return in this period. And conversely, the precious metals markets have only received a net of $19 billion in flows over this period, while they've been annualizing at plus 17%. A huge spread here in performance, yet we still don't see the investment public catching on to this change in patterns. We still see a lot of investors fighting in the last war in this regard. Now, if we look at flows into large cap equities and also juxtapose the flows into natural resource instruments, we see something similar. Even though the natural resource space has done really well over the last, let's say, 12 or 18 months, we haven't seen any type of interest at all from the investing public. This has us really excited because we generally prefer the empty bull market bus over the full bull market bus. Going back to this idea that we actually covered in our last newsletter, a full bull market bus, especially the people that are just getting on at the late stages, those are typically the folks with the least amount of conviction. They're getting in not because they believe in the story, or they're very well schooled in everything behind, or they're very well schooled in all the elements surrounding a certain asset class. They're in because their neighbor made money, or they see people on TV talking about it. And typically, those are the weakest hands. If things were to get a little dicey and a little rough in the coming weeks and months, we then could see some outflows from those weak hands, which could exacerbate what normally would be a typical corrective environment. In our last episode, I promised we'd have Marty Ruther, our CIO, on the episode to really go into what we think could be a major rotation event taking place. And here we go. I have Marty Ruther. Marty, welcome to the show.
Oh, Raj. Hello, everybody.
Marty's in St. Louis. I'm in St. Pete. Marty, is it cold up there, I'm guessing?
It's typical January. It's going to be 15 degrees last week. It'll be 60 and then right back to 15. So if anybody lives in Missouri, you know.
That's the St. Louis that I know. If you don't like the weather, you hang around for 8 minutes and it'll change. Boy, I tell you, it got pretty brisk last week after a really nice balmy couple of days a week and a half ago. Anyway, so
Yeah,
I'm
looking forward to coming down to see you in Florida. That'll be
Oh
a lot
yeah,
more fun.
absolutely. I'm ready for you. We've had a very interesting year, especially I would say the last 18 months has been quite interesting with terms of how all these variables playing out. One thing we were talking about before was this idea of this rotation. So I'm going to kind of get right into it and see what you think from your standpoint. We've been playing around with this acronym called FANG 2.0, and I'm using this thing called fuel and aerospace and defense, nuclear and gold. And it's really because it's just an area of the markets that are really forgotten if you look at your typical investment portfolio in the United States. So from that standpoint, looking at all the relational patterns and nominal patterns you've been perusing, over the last number of weeks and months, what are you seeing from your standpoint?
Well, I think that chart right there is interesting because people tend in nature to be late to a trend. And you really have to be paying attention early to see if things are starting to change. I always like to talk in terms of cracks. Is there a crack in a story? The FANG story, which has been unbelievable the last 5-10 years, really, even the last 3 years. Its momentum at the top is always impressive and very hard to distinguish the difference between the top of a trend and people just coming late to the party. But I look at this FANG 2.0 chart that you got on the screen, and what's interesting is we've seen now multiple months, years of a higher trend starting to form. And that's where you got to start to be aware that things are changing. So I think when you look at the narrative out there is, me and you meet people all the time. Technology's been great to a lot of people, and it's been great to our clients as well. But I think the real key to managing money is looking for the emerging opportunities. I tell clients all the time, most people don't sell because they're not looking for the next winner. They hold on to that previous winner. So the challenge for us, challenge for the people in our industry is how do we handle that change from the FANG 1.0 to the FANG 2.0? And what's interesting about the 2.0 story, you're starting to hear about that on the TV a lot as well. We don't have enough power for all this AI spending and AI build out. So I think, energy, power, defense, what's going on in the world, gold, obviously gold and silver, being in shortages. I think that's the new trend that what we need to do and what we're doing is we're taking those trends and putting against the old winners. We're taking the new winners and say, how are they doing versus the old winners? Because once you see that relative change here, like you're showing on the screen, that's when we know it's time to move. So that's what we're excited about this next year is, do we continue to see this happening? International stocks for the first time in, 4 or 5 years, I believe, outperformed U.S. That's been a very rare occurrence. They've been massive underperformers since 2010, 11 timeframe. So once again, we're starting to see the turn. Nothing's confirmed yet. But as we start to see that more and more change, that's going to be a sign where to go. And I'm sure you talked earlier probably about the dollar, U.S. dollar having a rough year in 2025. And that's another thing. Let's see if that trend continues.
Gotcha. Yeah, the dollar is amazing because it had a very strong 2022 when the Fed was raising rates. Now, since a year, let's say 15 months ago, the Fed's been easing rates, and now we're looking at almost a 10% decline in the trade-weighted value of the dollar. And like I said before, we've got $20 trillion plus coming due in Treasury rollovers, or at least maturing debt in the next, I think it's going to be about 24 months. So it's going to be interesting to see who's going to be the buyer, who's going to be the marginal buyer of those bonds. And of course, how will that impact
the dollar. And so this goes back to our long-term thesis in terms of what we want to generally own, and that is great companies. But along with all this stuff coming in with regard to, the kind of things you want to own, Marty, we also have this thing. It's kind of like the big elephant in the room, and that is this. It's almost like 17 years in, people are just becoming less and less concerned about corrective periods, volatility that's coming in, because everyone's been buying the dip, it appears. And buying the dip's been actually a good strategy for the past dozen years and change, where maybe you have a couple of months or maybe a couple of quarters of decline, but the market's come right back and it's all-time new highs within a year or maybe a little more. And sometimes if you go back throughout history, obviously it doesn't play out that way. And so what are your concerns with regard to that idea, with regard to, let's say, people being kind of just really not really concerned about any type of volatility that could emerge out there?
Yeah, I think what you've seen in the last 5 years post-COVID is the volatility swings are much faster, much higher. A 20-25% move in the NASDAQ or the S&P is really kind of normal. We're seeing these, I would call, bigger bars. When the bars in the market gets more volatile, you get bigger moves either way. The easy way to making money is when it just slowly goes up, tick, tick, tick. But as we saw all this money creation of the last 5 years, this chase for assets to, protect purchasing power, people are just saying, I'll pay whatever. And I'm just going to hold it because it's better than the dollar that's obviously getting weak. So I think looking at the trends, you're going to see, like I said, volatility levels spike quickly. So I think having portfolios that can take advantage of that volatility is going to be very important. What I'm afraid of for the average investor is they have a lot of money in low cost basis positions, whether it's index, ETFs, mutual funds, stocks. And as we've learned from history, people tend to not want to sell because they don't want to pay the taxes. But when you have 20-30% swings, that is your tax bill. So, and one of these times, you're not going to get that come back to new highs. So I think it's really asking yourself as an investor, do I have a solid risk management game plan when we're just really stretched off the moving averages? A very simple concept is standard deviation or a rubber band. Take a rubber band. We've all did as kids. You stretch it, and then you let go, and it snaps back. Well, we're at that stretch part because, as you've said in your podcast prior, valuations spread against the moving averages like you have there on the screen. Take the FANG index, large cap stocks. The previous low in April is 44% below the current price. Well, by definition, a downtrend is a lower low. So as you sit here today, as we sit here as asset managers, if you're buying the FANG stocks, where are you selling? Where are you saying, hey, we should take risk off the table? Well, that'd be either below the dotted line, which is probably 15%, the dotted line being an 8 moving average. So 15% or 44% is when you're selling. Well, I know our clients and most people, they don't like selling down 15, down 44. So that's that air pocket that kind of point to your rise we had last year in April. We got pretty far off that moving average and we went right down to it and kissed it. So I think the risk managed investor this year, starting the year, we're looking at, hey, what if we get these downside scenarios of 15 to 20 to 30 to 40%? How do we protect our clients from that and keep the gains that we have? Because it's been a great run, but you don't keep it unless you sell it or hedge it.
Right. That's a great point there. And I think this is where you also we talked about this in our newsletter just last week, a week and a half ago, and that is you've got a very full bull market bus in this state, in this area. Everyone is all in. And it's funny, we looked at a portfolio a couple weeks back, and there's this is coming from a recommendation from another asset manager where they had no international exposure per se. They only had they had exposure to a global manager. But the global manager, if you look at the top holdings, it's NVIDIA, it's all the big ones. And it's the same ones you see in the S&P, the same ones you see in the NASDAQ. And it's almost like almost 68% large cap US. And that's the problem. The problem is you had such a great bull market in that space. It has kind of infiltrated into all areas of the market. And of course, international investors are fully in the US markets as well because of their strong relative performance going backwards. So now we have the situation where it feels like everyone's in. And when you get that bull market bus so full, the people that just got on the bus recently, those are the people that typically have the least conviction. They're in it not because they believe in the stories or they believe, long term in the thesis. They're in it because they saw it go up and their neighbors made money in it, and they want to be part of the deal. That's the biggest problem about investing with human beings. We are social animals and we want to be part of the party. And however, those folks will also be the first ones to, to basically liquidate or get out when the volatility emerges, and that can kind of exacerbate any type of normal corrective process that you would normally see. So that's where we're being very cognizant of. So that's really interesting from that standpoint.
Right, and that's where, once again, that's why if you look at this last year for us and going forward, we're trying to really find other ideas. I mean, go back to the original question. Is the market rotating? The question is can we see the market rotating? Can we get in those spots? I mean, we're probably more out of tech in other areas than most people or the markets. The S&P for sure. I mean, it's interesting when you look at the S&P as a manager, like 10 stocks make up the whole thing, and you look at those 10 stocks, and you look at the valuations and the trends, how extended they are. It'd be really hard to buy that much of those companies. That just seems very imprudent. Our job is to make sure that we're, once again, finding those new opportunities so we don't have to take risks like that to get performance.
Yeah, I got you. I mean, basically, it's to you want to pass the puck to where the skater may be. I'm totally butchering this Wayne Gretzky quote, but basically, that's what we're looking to do, and that's in a sense the issue that we've had with this huge growth in these passive indexes. Because the passive indexes, I was just sharing with Marty earlier today, for instance, the small little oil service sector in the S&P is 0.2% of the entire market cap of the S&P. It used to be almost 30% of the S&P.
That's crazy. I think me and you. I mean, I remember energy was 10 to 12% of the S&P 500.
Yeah,
and that was probably early 2000, mid 2000s.
Yeah,
I mean, 2008, CNOOC, the Chinese energy company, was the largest company in the world.
Wow.
And I think, I don't know how many people on this podcast even know that company.
Not many.
17 years later. So it's amazing how things have changed. I mean, I remember when technology was 18, 19% of the S&P 500, and now it's 35, not including the communications sector. So it's been, like I said, it's been a historic run. And I think a good probably thing that people didn't talk about, a lot of people are kind of starting to talk about gold and silver now. But if you look at a ratio chart of gold relative to the S&P, it's been outperforming for a lot longer than the previous 2-3 months, where now everybody's starting to talk about it a little bit.
Right.
So that was a sign of, what really helped us last year. And once again, that was some of the early rotation stuff, is the gold and the silver market really started to outperform stocks, especially in the summer. So that's where having a portfolio that's designed to pick up that rotation of winners and not just keep the winners that you got. Because that's the problem that people end up having is, I've owned the stock forever, I don't want to pay the taxes. But when you have something else that you're confident is a good asset and something that you need to get into, it's good to force you to be able to do something. I would tell clients all the time, you want to have a reason to sell, whether it's for your kids' college or, retirement, or just, it's very important to have reasons, because otherwise you get caught up in all the hype and the movement. So for us, it's about when we see other relative assets like your FANG 2.0, we compare that every single day, every single week to the stuff that we own. And when you see that change start to happen, it tells you as a manager to make changes.
Gotcha. And this whole thesis is the market knows something or may know something that you may or may not know, right? That's the whole idea is you're deferring to the quote unquote wisdom of the markets. Tell me more about that idea.
I mean, I guess in the 24 years I've been doing this, if I look back at my most successful trades and allocation decisions, it's looking at the trend of the market and saying the market, once again, in the simplest form, it should be making higher highs and higher lows. I mean, if you go back to 2008 or 2000, the tech bubble, I remember on September 9th of 2000, Intel was the first company that warned on their earnings, because they were the big Cisco's, AOL's. And that was also the same time that Intel was starting to make lower lows. So once again, the definition of an uptrend is higher highs and higher lows. So when you see these stocks patterns start to change, that's telling you the market is probably anticipating something. Well, anybody who's been around as long as me and you know that obviously the next 2-3 years were very painful for the tech stocks. No different than the financial stocks in 2008.
Right.
So that's where, we look at it as nothing happens overnight. It's a series of events. And when those events start to change, it's important that you make changes. And typically, like I said, you're never going to be able to time the market perfect up on the top or bottom. But all the data, as you've explained in previous podcasts, all the data says you just got to play the middle, play the trend that's in favor. So many people try to pick that top and bottom, and that's where you could fail, because then you're kind of chasing the market versus what's the market telling you. So right now with FANG 2.0 outperforming FANG 1, that if we don't take the time to create that index and to actually have a thesis on why those things are going to do well fundamentally, you just get stuck with the same old story.
That's great. That's great. So when it comes to security selection, this is where we see a lot of problems you see money managers or even analysts get into. They learn about a story behind a particular company or maybe even an asset class. Let's say it was international stocks or emerging market stocks 10 years ago, which were dirt cheap, right? 10 years ago. Mm-hmm. Or a particular company that has a great story, great management, but the stock's dirt cheap. And 5 years later or 7 years later, we're still seeing languishing returns. So what is different about your approach when you're looking to identify companies to be in our portfolios? What's different about your approach from these other people that kind of fall in love with a fundamental story first?
Well, one thing that myself and Andrew and Corey here in the office do a really good job of is we have standards and criteria for each stock that we own. Is it, for example, if the S&P 500 is making a new high, is our stock making a new high? I mean, if your stock that you own is not making a new high when the market's making a new high, you got to at least ask yourself the question why. Especially if the market's making a new high and it's making a new low, you really got to ask yourself some questions. Like, why do I own this? I mean, we fundamentally believe in owning the winners, not the losers. So when you buy the S&P 500, you're buying all of them. You're saying, look, I can't delineate between winners and losers. Well, you can, in our opinion. You can delineate by performance. You can delineate by certain patterns and trends. So we focus a lot on the patterns and trends that typically anticipate what's going to happen, from a percentage standpoint. So if you got stocks making new highs, or one of my favorite ways to pick stocks is, or at least I shouldn't say pick stocks, it's identify. There's a big difference. You want to identify the winners. Is when the market's going down, let's say like in April of last year, S&P corrects around 20%, and you see a stock only go down 10, only go down 5. Because you go back to that April time period, it was what we call, people are really selling in masses. It was really like a deleveraging event. Mm-hmm. And we all remember the deleveraging events of 08, where it was just like every day the market's going down. So when you see stocks hold up performance-wise, meaning the S&P goes down 20, it goes down 10, then you're watching when the S&P comes back, does it lead back? And that's the best way to notice winners is how they act in the downturn. So in the last 2-3 months, we've seen technology and really momentum stocks that did really well during the summer really get hit pretty hard. Well, what held up? What held up was healthcare, energy, the FANG 2.0 type stuff. And what's interesting now is we're starting to see, as the market came out of that November correction, those stocks are making new highs, and the tech stocks are not. So right there, that's the beginning of the change. So I think watching the relative patterns, seeing where the strength is when the market's going up and down, tells you a lot.
That gets me really excited from the macro standpoint. And as a contrarian, Marty, looking at all the research I've done over the years, knowing how investors en masse are really bad timers, and I'm seeing the investing public all in on the tech sector essentially, which are great companies, and they've done phenomenally well. But it feels like they've completely avoided or just forgotten about other areas that are actually showing some nice relative strength from a price standpoint for a while. And that is a really that's a very unique opportunity, because these spaces that are showing this relative strength are very small from a market capitalization standpoint. And when you're talking hundreds of billions of dollars or $1 trillion plus of individual flows that have gone in one direction, if that were to reverse, that could be a very strong tailwind for some of these areas that are actually showing some nice price action lately.
Yeah, but I think when you look at the average market cap of the S&P 500 stocks, so take the 500 stocks and say, what's the average size of that company? The largest being NVIDIA, around 4.7 trillion. The average for the 500 is 38 billion. So that's less than a 10% drop in NVIDIA would wipe out basically the bottom half of the S&P one by one. So I think what's important to understand is these tech companies are great companies. We always say own great companies. But when it comes to managing risk is when do I want to own them or how much do I want to own them at the time? So NVIDIA, Apple, that's 7-8% of the S&P 500. We tend to look at it and say, hey, these are great companies, but maybe we want to own 3-4% positions or something less. This is not the time to be, all in, not 100% out, but not all in. So I think a big part of managing risk is knowing that these are great companies, but when are they bad stocks? And that bad stocks goes back to what I talked about before. If it's not acting as well as the market, if a stock isn't outperforming the market, you have to ask yourself, why do you own it? Is it taking a consolidation? Is it taking a break? So I think when we find in our situation, when we have these type of situations, is do we sell it or hedge it? And that's where options, really a big part of a portfolio of managing risk is we can use options to blunt the volatility of owning that position we've owned a long time, but we don't want to sell it. But we also don't want to write it down 44%. So I think that's where one thing I think we do differently than some people is we at least have that in our bag of tricks in a sense. We have that in our toolbox, to pull out that. So for example, this year we did that a couple times with some of the tech stocks and they keep going higher. And, I don't know where the top is in these things. I just know we're going to stay in the trend as long as we can. And that's where the options really help. We do that with the precious metals. I mean, it's probably one of my favorite trades for this next year is the precious metals are in strong uptrends. How do we keep our clients in a winning trade? I mean, it's been a huge trade for us, positive in 2025. And let's use the options market to stay in those trends.
That's a great point because the hardest thing to do when you have obviously a very sharp bull market, and if we look at, for instance, I'll pull up the chart of silver here, and here we go. So here's the chart of silver, and this goes back to the early 70s. And so you see silver had this nice run to $50 and change back in 1980. It corrected all the way down to $5, for the better part of the next few decades. It got to almost $50 in 2011, and of course it had not quite the correction, but of course now you see the move more recently up into the 70s. This obviously looks kind of parabolic from that standpoint. It is a very small part of the spectrum of assets out there. We're talking 5 trillion market cap for all the silver in the world. And what's so compelling from this story and now is that by looking through, we're seeing better than 80% of all the silver extracted out of the ground is actually consumed as a paste with electronics, solar panels to, your cell phones to everything in between, electronically speaking, because it's such a great conductor. So there's only 20 cents in the dollar that's extracted out of the ground actually stays as a metal. And the rest is in these electronics, which are not recoverable, at least anything close to current prices. So from the fundamental standpoint is very compelling, but yes, this chart here can make it look a little dicey with regard to how far it's moved in such a short amount of time.
But that's where also, we'll be, rebalance a little bit. You take some chips off the table. If you have a target asset allocation for precious metals, try to rebalance to that. Buy some options to kind of stay in that trend because a trend is what do you call it? It feeds on itself. It's like an energy, right? Raj always like to say it's kinetic energy, and these tech stocks have gone a lot higher. I mean, I remember when Apple was 15 times earnings when they didn't have a big phone, and everybody's like, Google's going to win, and now Apple came out with a phone years later. Now it's 40, 45 times earnings, and it's the same company. So, it's the important thing is to notice the trend, manage the risk in the trend. So going back to, in closing on our original question, where is the market rotating to? That's where we spend a lot of our time, is where are the other opportunities, not the ones from last year or the previous years. Keep on the hunt.
Okay, great, Marty. That was awesome. We will continue this conversation on another episode. And to everyone out there, thank you for your time, and we will be in touch.